Imagine standing at a crossroads in the world of trading and investing. On one side, technical analysis, TA, with its charts, patterns, and indicators, whispers promises of precise entry and exit points. On the other, fundamental analysis, FA, appeals to your logic, offering a deep understanding of the factors that truly drive markets. Which path should you choose? More importantly, which one holds the key to wealth and success in trading? In this scenario, we'll explore the strengths, weaknesses, and applicability of both approaches, guiding you toward a strategy that fits your goals. Chapter 1. What is technical analysis? Technical analysis is the art of interpreting price action. It's based on the idea that all relevant information is already reflected in the price, and historical patterns tend to repeat themselves. Some of the core principles include trends and patterns, identifying uptrends, downtrends, and sideways markets through tools like trend lines and channels. Indicators, using moving averages, RSI, MACD, and Fibonacci retracements to predict market behavior. Support and resistance, spotting price levels where buying or selling pressure has historically been strong. TA's primary strength lies in its universality. Whether you're trading Forex, stocks, or cryptocurrencies, the principles remain the same. But here's the twist. Is relying solely on past data enough to predict the future? Chapter 2. What is fundamental analysis? Fundamental analysis delves into the why behind market movements. It examines macroeconomic factors, company performance, and global trends to assess an asset's intrinsic value. Some pillars of FA include macroeconomic indicators, GDP, interest rates, employment data, and inflation trends, company metrics, earnings reports, PE ratios, and revenue growth for stock traders, global events, geopolitical developments, trade agreements, and technological breakthroughs. FA helps you understand the story behind price movements. For instance, why did gold surge during a global economic crisis? Or why does a company's stock soar after announcing breakthrough technology? But here's the catch. What if the market doesn't behave as expected despite strong fundamentals? Chapter 3. Head-to-head comparison. Let's break down the strengths and limitations of both approaches. Aspect technical analysis. Fundamental analysis, speed. Quick decision-making using charts requires in-depth research. Focus, short-term price movements, long-term trends, and value application. Works across all time frames. Best for medium to long-term accuracy in volatile markets. Effective in identifying patterns. Often lags due to slower reactions. Learning curve visual and relatively quick, requires understanding of economics. Clearly, neither approach is perfect, but what if combining both could lead to a winning strategy? Chapter 4. The winning combination. In practice, the most successful traders and investors often use a hybrid approach. Here's how it works. 1. Start with fundamentals. Use FA to identify assets with strong potential. For example, research reveals that a company is expanding into a high-growth industry, or that a country's currency may appreciate due to rising interest rates. 2. Refine with technicals. Once an asset is identified, use TA to pinpoint optimal entry and exit points. For instance, wait for a breakout from a resistance level or confirm an uptrend before taking a position. Example: a trader may see Bitcoin as undervalued due to institutional adoption, FA, but waits for a bullish breakout from a consolidation phase, TA, before buying. Chapter 5. Misconceptions about TA and FA. Both methods are often misunderstood. 1. Technical analysis is only for day traders. While TA is popular among short-term traders, long-term investors use it to time entries during pullbacks or corrections. 2. Fundamental analysis guarantees success. Strong fundamentals don't always lead to immediate price increases. Markets can remain irrational longer than you can stay solvent. Avoiding these misconceptions is crucial for a balanced perspective. Chapter 6. Real-life case studies. Case 1. The 2008 financial crisis. FA Insight. The housing market bubble and risky lending practices were red flags long before the crash. TA Insight. Charts revealed clear downtrends and warning signs in financial sector stocks months before the crisis unfolded. Case 2. Tesla's meteoric rise. FA Insight. Innovations in EV technology and strong revenue growth signaled potential. TA Insight. Breakouts from key resistance levels provided clear buying opportunities during its rally. These examples highlight how combining TA and FA offers a complete view of the market. Chapter 7. Which approach is right for you? Your choice depends on your goals and personality. TA enthusiasts. If you enjoy fast-paced trading and thrive on quick decisions, TA might be your go-to. FA followers. If you prefer deep research and long-term investing, FA is likely more suitable. Remember, the goal isn't to choose one over the other, but to create a balanced strategy that works for you. The ultimate takeaway. So, does technical analysis or fundamental analysis make you wealthier? The truth is, wealth in trading isn't about the method. It's about discipline, risk management, and adaptability. The most successful traders understand that the market is a dynamic battlefield. They don't restrict themselves to one tool. They master both and use them in harmony. The real question isn't which is better, but how will you use both to your advantage? The market awaits. Are you ready to conquer it?